Hello everyone, and welcome to another episode of the Daily Gwei Refuel, where I recap the latest news in the Ethereum ecosystem. I'm your host, Anthony Sassano, and today's the 1st of September 2021. Alright everyone, let's get into it. So, Arbitrum is finally here. Arbitrum One is now live on mainnet to the public. I'm sure many of you have used it already. I have bridged in some assets to Arbitrum's Layer 2 network here, and been using a couple of the apps on there. I think there's just a few apps live right now, with more coming over the next few days, but there's Uniswap, SushiSwap, Balancer, and maybe one or two other ones that are live right now for you to kind of go try out and everything like that. But they have limited liquidity, obviously, because people have to add liquidity over time to these kind of like new apps on Layer 2 that don't inherit the liquidity from Layer 1, obviously. But I tried to trade. I did a trade on SushiSwap, just a small one. And I think MetaMask is also doing the fee estimation wrong on the Layer 2. So that's just like a little bit of quirk that needs to be kind of figured out there. But from what I'm seeing, I think the proper fee that people should be paying for like a normal swap is about $1 right now. Now, you know, I saw some people saying, wow, that's still like pretty expensive, right? It's obviously much cheaper than mainnet, but it's like it's not, a few cents for a transaction or whatever. And I've kind of mentioned this before, and I've gone through it before. But the funny thing is about Layer 2s is that they are basically the opposite of Layer 1 when it comes to like the fee market. Because Layer 2s work off economies of scale. Whereas with Layer 1, you kind of have like, I guess Layer 2s work the same way, where once the kind of chain gets clogged, it reverts to kind of like, doesn't revert, but like the fees start going up, right? If you reach the transaction capacity on the chain, whether it be a Layer 1 or Layer 2, the fees will go up to compensate for that, because people are trying to compete with each other to get their transactions in. But the thing with Layer 2s that makes them different to Layer 1s is that, well, at least rollups, is that rollups have to post their batches and their proofs to Layer 1 to inherit the security from Ethereum. That's kind of like how they get their security and kind of like, and they have to pay for that, right? They have to pay for Ethereum block space. Now, they charge that to the users. Obviously, the kind of like users are paying the fees on the Layer 2, and those fees are going to the validators or the sequencers, as they're called, on these kind of like rollups, and they will pay that to the base chain, and whatever that kind of works out to. So Optimism is paying anywhere from $50 to $150,000 a day in fees for those batches and those proofs right now. I'm assuming Arbitrum's going to be about the same as well. As they kind of post those each day. It is not cheap, definitely. Kind of not cheap there. Actually, wait, no, sorry, I should correct that. I should say that Optimism, the Layer 2 network, is generating $50,000 to $150,000 worth of fees, but it is paying a large chunk of that to Layer 1 to kind of like to kind of verify themselves, or secure themselves, I should say. So I would expect the same for Arbitrum to be true. But the thing is that when you're on Layer 2 and you have more and more users, what ends up happening is that you can charge the users less, like as a kind of like individual, but in aggregate you have more fees. So for an example, if you have like 1,000 users on the Layer 2, all paying like 10-cent fees, right, then that's good, right? That's fine. Like, users really love that. That's all well and good. That's what they expect. But if you only have 100 users on there, well, you need to charge them $1 fee to have the same kind of fee revenue. Do you see where I'm going with this? So the more users you have on there, the more transactions per second you have enabled too, because, Arbitrum and Optimism claim to be able to do a few thousand transactions per second. They're not enabled to do that right now, but the demand's not there anyway. So even if they put that, kind of enabled that, it wouldn't really matter. But essentially, that's kind of like what's happening there. So as we get more users onto these kind of layer 2s, as we get more individuals paying less fees because there's more aggregate fees, then you'll be able to enjoy the benefits of like those super low fees. But still, I think $1 for kind of like a Uniswap or a SushiSwap trade is absolutely amazing, considering they're coming from the Ethereum mainnet, and you're still inheriting Ethereum security, mind you. Like, this isn't a different chain where it's with its own validator set. You're actually still inheriting Ethereum security. So I did want to clear that up a little bit there and explain like how Layer 2s rely heavily on economies of scale, and as they kind of build up over time, the fees should logically get cheaper over time, unless we get to a point where the transaction capacity on these kind of like Layer 2s is at thousands of transactions per second, and that's all being filled, then obviously the fees are going to go up. But I don't think we're going to get there for a little while. It's actually funny when you think about this, and think about how many thousands of transactions are per second. That's a lot of transactions. Like, there's a lot of transactions on the Ethereum mainnet, but the reason why that the fees are so high is because of the fact that the Ethereum mainnet is pretty much doing only 15 transactions per second right now. But there's lots and lots of transactions that want to get in. That's why the fees are high, and Ethereum is limited because of that. And that's why I guess we see people kind of like outbidding each other. But if Ethereum was more scalable, say, you know, you increase Ethereum scalability by like 10x, I actually don't think we would be able to fill in 150 transactions per second, even on the Ethereum mainnet right now. Over time, yes, but like I'm talking about right now. So the demand just isn't there just yet, but it will be. And it definitely will come faster than we think. But I think once that happens, these like layer twos will definitely have the capacity enabled for that and won't have so much these guardrails in place. They'll still have some guardrails and everything like that. But yeah, I just wanted to add some color there because I saw some confusion around that. But back to Arbitrum's announcement here today. So essentially, they went through exactly what this is. So they're calling this a mainnet beta. It is not like a full mainnet thing. It's still in beta, which means there's basically centralization everywhere. To put it kind of like in that term, I guess it's not a bad thing. I mean, the most centralized aspect of it, I mean, it's fully centralized because they can essentially pause the chain. So if something they see something going wrong or there's a security issue, they can pause the chain and kind of look into it and do what they need to do on the chain. So from that point of view, it is centralized right now. But that's okay because they're telling you that it's going to be that. They're telling you that they can do this, and it's totally fine because it's in beta. It's still very early with this sort of stuff, and this is exactly what's happening. Then they've also got a speed limit on their mainnet here, sort of like how Optimism has their speed limit of 50,000 transactions per day. I think it's 100,000 transactions per day now. With Arbitrum, they're starting at about the same, I guess, like capacity as Ethereum L1. So about that 15 transaction per second mark there. Now, as I was explaining, this is going to increase over time up to the thousands of transactions per second that kind of like Arbitrum and I mean Optimism as well and some other L2s will support. But for now, they're starting there. And I think it's going to just rely on the how many people use the chain and kind of like what the capacity is like. Because what ends up happening is that if that kind of limit gets hit on the layer 2, you're going to run into the same issues that you do on layer 1, where the fee starts skyrocketing because there's lots and lots of demand. But the beautiful thing about these layer 2s is that Arbitrum, obviously it's centralized right now, but what Arbitrum can do is that they can just like up the limit on their own, right? They don't have to go through like the governance process of layer 1 to up the gas limit. There's actually not as dire consequence. I mean, the consequences aren't even dire or anything like that. It's just a very different kind of thing. Like, as opposed to increasing the gas limit on layer 1 in order to kind of like get more TPS out of the layer 1 chain, with layer 2, it's basically, I mean, it's a similar concept. I guess you could call it like making the block size bigger, I guess, if you want to use that term. But the consequences of doing that at layer 2 are basically, you know, pretty much non-existent. It does increase the size of the chain, but the point of layer 2 is that, you know, it's secured by layer 1, so that doesn't really matter at the end of the day. And you can run it on kind of like the more beefy hardware to sequence these things out. So, yeah, I'm expecting them to kind of like increase that over time. The whitelist is gone, so anyone can permissionlessly, I think, add their kind of like contracts to the chain now. I think that's actually, maybe I'm getting it wrong here. They say, we have removed restrictions on who can transact with the network. Okay, but we will continue to have a whitelist in place for adding new tokens to our bridge and being an active validator until the ecosystem further matures. Okay, well, that's fine. I guess like who can transact on the network, which means like any of us can. Like we can go in with any Ethereum address that we want, bridge in with any token that's supported, and it's all well and good. So they're actually just keeping the whitelist in place for the token and the validators and all that sort of stuff, which makes sense. And then they say here that their goal with this limitation is to protect users and ensure that it will be easy to recognize which L2 tokens correspond to their L1 counterparts. And then they go on to say something really exciting where they said, we have also secured commitments for several highly reputable validators to validate Arbitrum, and stay tuned for upcoming announcements on this. So validators are kind of like, I call them sequences sometimes. They're basically just like these things that you know, take in the transactions, construct the blocks, and, you know, publish those blocks, and like, you know, have the layer 2 chain chugging along like that. And the main difference though with layer 2 versus layer 1 is that you only need one validator online. And even if that validator was to go offline, because of the way layer 2s work, you'd be able to get your funds back because they're in the bridge contract on layer 1. So it's very different. I mean, this terminology is going to confuse people, I think, because validator is a very, I guess, loaded term because it's used in different ways. You have validators in Ethereum's proof of stake. You have it in delegated proof of stake on other chains. You have it on layer 2s. You have it on like side chains. I mean, there's all this kind of like terminology that kind of like, I guess, blurs the lines between different kind of like implementations. So there may be a bit of confusion there. But in the terms of like Arbitrum and how they're talking about this, it's literally the same thing, just the things that construct the blocks and kind of like put the transactions in. But you only need one of them to be live on the layer 2 network for it to process transactions. And that one can censor you in theory. But the thing is that even if they do that, you can still get your funds back. They can censor your transactions and say, well, I'm not going to let you do a trade on layer 2. But who cares? Because at the end of the day, if they start doing that, well, I would say that this layer 2 would quickly lose credibility and quickly lose user support. But the thing is your funds are fine. Your funds are safe because you can withdraw them on the layer 1 smart contract, the bridge contract. And that is the entire point of layer 2, is that doesn't matter what happens on layer 2, you should always be able to get your funds back on layer 1 by triggering that emergency withdrawal from the bridge contract. And that really is the key innovation at the end of the day, in my eyes anyway. And then they have like a bunch of other kind of like details here about the pausing and fast bridging, the bug bounty that they announced, which is a $1 million bug bounty managed by ImmuneFi. Maybe Samsung is going to get himself another $1 million with this bug bounty program. And then kind of like talking about what's next and a bit of thank yous here. So I'm sure all of you have already read this post, and I've been talking about Arbitrum for a long time now, but it's really awesome to see that it is finally here. It's going to I guess keep getting better over time. The next few months, I mean, we're in scalability spring, or kind of like Arbitrum autumn, I guess, if depending where you are in the world. I like scalability spring, but obviously like most of the world is not in spring right now. It's only Southern Hemisphere thing, but it has a better ring to it. But yeah, exciting times. I'm super excited. I really enjoyed using kind of like Sushi Swap on layer 2 on Arbitrum. I did end up paying like $4 or $5 in fees, but as I said, I think that's because MetaMask kind of like was not doing the right kind of like fee estimation there. So I'm going to have to look into that, but that's just growing pains at the end of the day, and I think that's fine. I was just testing it out, and the liquidity wasn't even good. I was literally doing like the smallest test I could do. I think I traded like $50 worth of ETH for USDC just to test it, because doing any more of that would have led to like insane slippage. But the liquidity will get better. I'm sure there'll be token incentives, and I'm just really looking forward to seeing how this all shakes out. But yeah, I'm going to move on from that. Obviously, I'll keep talking about Arbitrum over time, but I don't have to say it's coming soon anymore, which is nice. All right, so another bit of exciting news out of ConsenSys was that they announced MetaMask now has 10 million monthly active users. So the last time they talked about MetaMask's monthly active users, they had 5 million, was I think the last time they kind of announced the number. And that was back, I think, earlier this year. I remember in October of last year, they announced they had 1 million monthly active users, which was a big deal at the time. Then they had 5 million. Now they've got 10 million. And the interesting thing about MetaMask is that this isn't just Ethereum, right? Because MetaMask supports any type of EVM compatible network that you want, and everyone's using MetaMask. Like, if you look at the EVM compatible networks of like the Polygon POS chain, Avalanche's C chain, you have Phantom now as well. You have obviously BSC, and then you have Ethereum and its layer 2 ecosystem like Arbitrum and Optimism, ZK Sync, like all of that sort of stuff. Like any of those networks that you kind of like add to your MetaMask, they're all kind of in there. And that's what, I guess, like is making MetaMask the staple kind of wallet within the ecosystem. Now, it's funny because 10 million monthly active users is not very much, right, at the end of the day. This is a very tiny portion of even the crypto community. I think that during kind of like, I guess, bull markets, there's probably at any one given time, like in terms of monthly active users, probably 100 million plus, because you have to talk about like the exchanges and people trading on there, individuals trading on there. Like I'm talking about like the peak manias when you basically got like your best friend's uncle asking you about Cardano. Like I think that like the peak of the kind of like market, it was for me at least. I had one of my friend's dads ask me about it, and then the whole market had that massive crash, and I was like, okay, well, maybe that's a top signal next time. Maybe. But regardless of that, that's kind of like what I'm looking at in terms of the kind of like adoption rate here. And I think that just because there's 10 million monthly active users on MetaMask doesn't mean this is 10 million actual individual people, because people can have multiple MetaMask wallets on multiple browsers. For example, I have a MetaMask extension on my desktop, and I also have one on my laptop, but I also have one on different browsers on my desktop. Like I have Chrome, I have Firefox, and I use it for different purposes. So there's that. And then you have and then I don't know if they're actually splitting up the mobile users and the desktop users. I don't think there'd actually be a way to do that unless they I actually don't think there's a way to do that because it's two different instances of the app. So essentially, they're doubling up there. So I'd actually say realistically, you could probably cut this down to probably at least 5 million real kind of people in terms of like monthly active users, which is just even more bullish because we kind of like see that there's not that many people kind of like in this ecosystem just yet, and there's still a lot of potential for growth here. But generally, you can see the kind of chart here. There's only been like one dip, and that was after the crash. But, since then, it's been going nuts again. And I think this is definitely because of the fact that, NFT Mania took off. There's a lot of people onboarding through that. MetaMask is the gateway wallet for pretty much like everyone these days. I mean, it has been for a few years now, but I mean, if you're in Ethereum, you've used MetaMask. It's simple as that. I would actually love to meet someone that's in Ethereum that hasn't ever used MetaMask or heard of it at least. That'll probably be the day that we enter like the mass adoption phase when not everyone's using the kind of like the same desktop wallet that we've all been using for years. But yeah, it's still cool to see this growth. And, another bit of growth that I've been monitoring as well is kind of like the users of the individual apps. Like with DeFi, there hasn't been that many, but what even surprised me more was the OpenSea users. So I went on this Dune Analytics dashboard that's tracking different metrics for OpenSea. There's got like the total users, not the active users, the total users, or at least the total Ethereum addresses that have touched the OpenSea smart contract. So essentially used OpenSea OpenSea platform. I think it was 320,000. I checked this a few hours ago. 320,000 Ethereum addresses, not people. Now, I use multiple addresses for OpenSea. I don't know about any of you guys. So even if we say that that number is like pretty much overstated, say it's overstated by 120,000, just to round it out to 200,000, that's not even half of what it is. But let's just say that for argument's sake, 200,000 people, like if we're talking about real humans, have interacted with OpenSea, and OpenSea saw $3.3 billion of real volumes on their kind of like, on their platform, and they took in $250 million of fees just in the month of August. I mean, that's an insane amount of growth still to go. Like 200,000 people is nothing. Like think about how big the gaming industry is, how big the art industry and culture. I mean, culture is everywhere. Like think about what happens when OpenSea gets to, not just OpenSea, but like NFTs generally get to 100 million actual people and users in here. It's just absolutely insane to think about the volumes that we're going to be seeing on these things. The amount of kind of like money that's going to be made and lost. The amount of like, I guess scams we're going to see as well, because scams always follow the mass adoption stuff. But generally, there was this meme that I posted yesterday about the early adopter. You probably saw it, where it's like, it looked like me a little bit. Like it had like a shitty little beard and like some shitty little hair. But people say, you should put the hat on this because it'll look exactly like you. But this is something that I always go on about, like how early we are. But I'm not just saying this to pump bags. I'm saying this based on the actual data that I'm seeing. You can't fake the on-chain data. You can't basically remove, a million addresses from the pool that's touched the OpenSea smart contracts. That's not possible. Yes, you can have bad data, but this data and this dashboard has been verified. I'm like 99% sure it's accurate. Maybe there's a 1% chance it isn't for whatever reason, but it's just insane to see kind of like how much volume has been generated based on not even close to 1 million users and this is total. This is not active users as well. This is total. So we still have an incredible amount of growth left to go within the NFT ecosystem, especially OpenSea. I mean, OpenSea is going to be, one of the kind of like, I guess, people are saying it's like the eBay of crypto. I think it can be like much bigger than that. I think it could be like the Amazon of crypto, and they don't really have much competition, and they've got like a massive network effect as well. It's just going to be absolutely amazing to see how much more growth is in store for them, given that there's not many users in this kind of ecosystem just yet. But yeah, I mean, just generally when thinking about rate of adoption, where we are in the adoption cycle, we are still in the early adopter phase. Like as I said, I think maybe a few months ago we kind of came out of the innovator phase, and now we're in the early adopter phase because of NFTs, I believe. And then we're going to go through that, and then we're going to get to the mass adoption phase where most people come in, and then obviously, we'll get to the late majority and stuff, but this is going to take years and possibly even decades. We may think that we're getting like this adoption much faster than what we are, but we really aren't. Like as I said, there's only 320,000 Ethereum addresses that are interacted with OpenSea, and there's already $3.3 billion of volume being generated there. I know that it's a mania, but that doesn't matter. If you can have a mania with such a small pool of Ethereum addresses, imagine what it's like when we have 100 million Ethereum addresses interacting with OpenSea and NFTs in general. It's going to be wild, right? So yeah, I guess like congrats to MetaMask for these 10 million monthly active users here. it's really great to see them kind of like growing. I mean, there's going to be plenty of other wallets coming out. They're going to have their own kind of like users in this ecosystem as well. So we're going to have to keep an eye out for that. But anyway, moving on for now. So there's been this thing that everyone's been talking about in the NFT kind of ecosystem right now called Loot Project. Now, I've seen a few people confused about what this exactly is. And I guess a bit of a disclaimer here, I own one of these loot bags. I bought a Divine Robe. It's kind of become like a little bit of a meme. I bought it a few days ago from my public address, so I'm not trying to hide it or anything like that. But essentially, what this loot project is a bunch of NFTs that have text on it. So they have like a bunch of items written in kind of like text on the NFT, and it'll be kind of like this divine robe or like, you know, molten ring or kind of like divine hood or whatever you want to call it. Like, you know, if you played an RPG, you'll get what I'm saying here. And people are kind of looking at this and they're kind of like, okay, well, what is this? And Tandavas here put like a really great thread out where he basically says, this is essentially, or at least what's happening with loot right now, is it's a bottom-up approach to an NFT. And you can see in this kind of like picture, what he means is that the typical NFT is a top-down approach. You have the creator that creates the art, right? That creates all the kind of like value around it, sends the airdrops, grows the fan base, all that sort of stuff there, and creates a lot of the value, and then puts that into the NFT, and then the users buy the NFT and kind of like speculate on it and do whatever else. Whereas with loot, it's a bottom-up approach where you have the collector actually feeding the value up to the NFT instead of the creator. The creator obviously created this thing, but they didn't create the art for it. They didn't do any work around it. They basically said, here's the NFT, here's the text associated with each one here, and you can do whatever you want with it. You can build on it. You can kind of create your own metaverse around it. It's basically a blank canvas for anyone to come along and build their own ecosystem around this NFT set. So you can see here that the collectors at the bottom sending the value up to making the NFT valuable themselves by building the game, creating the avatars, building the metaverse, writing novels about it, doing anything that there is to do within this kind of like game here. Now, if you guys haven't seen this before, this is what kind of these items look like. This is literally the NFT here. You can see there's a bunch of items in there. You buy this. There's people working on smart contracts to split these items up actually into individual pieces, but people are taking this and drawing and creating art out of it. Like you can see here, like a wool sash. People are drawing this kind of stuff. They're drawing holy greaves, divine robe of perfection. They're drawing that. They're making art around it. People are building derivatives on top of this. They have like kind of like I think he's got an example here of derivatives and stuff that's kind of like that's here. He gives a few different examples. Yeah. So basically, people creating like worlds, like realms, that they like to call it, or kind of like lands within it, creating other kind of derivatives on top of it that current loot holders can actually mint from the smart contract. So there's a lot of that stuff going on. The best analogy that I've come up with for this is kind of like, it's like I guess like a Minecraft for like NFTs, because with Minecraft, the reason the reason it did get so popular is because it basically gave I guess like everyone the ability to create whatever they want. It was a blank canvas. There was no one telling you what to do. There was no story. The creators didn't say, hey, you had to do this or had to do that. They gave you the tools, right? Just like you're getting the tools here, which are the items in this case for loot, and you can do whatever you want with them. And this is exactly like Ethereum, if you really think about it. The Ethereum platform is permissionless to build on, decentralized. The tools were given to you. You were given the Solidity smart contract language. You were given smart contracts in general, right? You were given a platform to build on and a network to build on, and then people have built whatever they wanted on it. They built DeFi, they built NFTs, they built DAOs, they built tokens. They built everything they wanted on it, and continue to do so. So this is where the real magic happens. When you give people a blank canvas, they'll create whatever they want, and that creativity can come from anywhere. And that's why it's so powerful, because this is global as well. And obviously, being an NFT, people are speculating on this, and the floor price actually went nuts on this. I saw it at 0.5 the other day. It's gone up to like 6 ETH on the floor. It's absolutely crazy how much this has kind of grown. But I think it really is special, because it means that basically anyone, not that it means that anyone can kind of like acquire these items. Yes, they're very expensive. 6 ETH isn't cheap these days. It's what, like $20,000 or something like that. But I think anyone can build on top of this. Anyone can kind of like draw the art for it. They can build the game themselves. They can come together in a community in Discord and start agreeing on kind of like the best approach here and all that sort of stuff. There's just like an open field here for creators to go to town on this sort of stuff. And you also have a community that you can tap into, because the community owns these things and they want to be able to kind of like visualize it and they want to be part of a game in a metaverse. So yeah, I mean, that's just really exciting for me. I just wanted to explain it for those that may be kind of like confused by this. But generally, yeah, this has been pretty cool to see play out. And this thread is really, really great. You can go check it out. It'll be in the YouTube description. But yeah, just wanted to give it a bit of extra color there. So speaking of NFTs, Dave White from Paradigm introduced something that he's been working on called the Floor Perpetual. So what floor perps are a synthetic NFTs that track the floor price of a given project and can be minted by locking up NFTs from that project. And he goes on to say, imagine you own some ocelots, I think that's what it's called. There's some cats here from the wildly popular Awful Hot Ocelots project. You love your ocelots dearly and refuse to sell a single one of them. However, they now make up a significant portion of your net worth and you would like some liquidity. If you owned a single rare ocelot, you could fractionalize it on Fractional, the fractionalization platform. But your ocelot, I don't even know if I'm saying that word right. I'm going to say cats. But your cats are still priced near the floor and their shares are unlikely to attract much interest. You believe they will increase in value relative to the floor over time. You decide to use your cats as collateral to mint and sell cat floor perps. Not only do you get immediate liquidity, you're also protected if the floor price drops. You will miss out on profits if the floor price rises, but still stand to gain if your cats appreciate more. So this is, I mean, next level kind of stuff. And I mean, he gives a really great explanation of it in this post here. I highly recommend going and reading this. It'll be linked in the YouTube description. But essentially, this is, again, another kind of like innovation within the NFT space that is going to unlock more and more kind of like usage and utility because it's adding liquidity to NFTs, which is essentially like a major pain point because of the fact that NFTs by design, you either need to be fractionalized or kind of like put into an index to get liquidity because they're not fungible unless you do that. Whereas being able to generate a synthetic perpetual product on top of it by using these NFTs as collateral for that is really awesome. I mean, I think this is huge, and I'm sure. I mean, Paradigm are backing Fractional. They led their seed round, so I'm sure that Fractional is probably going to add this as a feature to their platform. And I can't wait to do this. I would love to be able to put up some of my NFTs or my floors, like my floor punk that I never planned to sell as collateral to kind of mint these perps and stuff like that, and kind of like see how that goes as well. So yeah, this is a really, really cool idea. But yeah, definitely go read this blog post from Dave White for more kind of like details on that. So speaking of NFTs, DeFiAlliance today announced that they're launching a Gaming Accelerator. So they say it'll help Web3 startups with game design, community building, and more. And they have a bunch of really awesome mentors on here, such as Jihoz from Axie Infinity, also Gabby Dyson from Yield Guild, Austin Griffith, famed Ethereum builder, and a bunch of other great people here. And you can basically apply by September 19th to be part of this Gaming Accelerator. So if you go to this website, it'll come up with a form, and then you can fill out this kind of form and everything like that, and then submit it, and hopefully you can kind of get chosen there. So I just wanted to point out that for anyone who I guess like is part of a Web3 startup for gaming or part of a community or whatever, and wants to get more involved in this sort of stuff here. So I think this is the last thing or second last thing on NFTs. So PleasrDAO has launched their Doge NFT that they have as a fractionalized. So they're fractionalized that, sorry, I should say. And you can buy the dog token to get a share of this Doge NFT. Now, this is really cool. Like this video that was created by a couple of really awesome people, People Pleaser and Cloud Eater, with music by Bassjack is here. But essentially, I mean, look at this video. It's amazing. For those of you listening in, go check this out in the YouTube description. But this is just hilarious. And there's music as well, but I haven't got that hooked up to record at the moment. But essentially, I think this is really cool that PleasrDAO, which is a DAO made to acquire really rare NFT pieces, are letting people purchase a fractionalized share of this instead of kind of like having to on-sell the piece. So the community ownership can still exist while the DAO still gets kind of like the upside from this as well. So I just thought that was really cool to point out there. I'm going to get through the rest of these in a quick fashion because of the fact that I'm running out of time here. So last thing on NFTs, DCInvestor put out an interesting tweet today where he said NFT prices will fluctuate based on ETH USD fluctuations, but the unit of account for pricing NFTs is and will likely remain ETH. It would not even surprise me to see ETH travel to other chains to settle NFTs there. USD hegemony isn't compatible with a global metaverse economy. I agree with this. do you still think we're going to have to wait and see how it really plays out with regards to if ETH will remain the dominant money within the NFT category? Because at the end of the day, I mean, we're pricing NFTs in ETH and everyone's trading in ETH. And I think that's fine for crypto natives. But as more and more kind of like, I guess, non-crypto natives get onboarded into the ecosystem, and they might prefer to use a stable unit of account, such as USD, like a USD stablecoin or like a Euro stablecoin or whatever else. But on that note, one other thing I wanted to talk about was in relation to this, was the fact that people are talking about, do NFT prices go down if ETH goes up? I think it's funny because we don't have enough data here to actually point out, I guess, what would happen in this scenario. But I think from my point of view, from what I've seen, at least with the limited data that we have, if ETH is going up, that means people that hold ETH have more money, which means that they have, but that means that when ETH starts kind of like slowing down after it's gone up and kind of like starts crabbing again, through its price range, doing it like a crab season, that means people holding ETH are like, okay, well, I'm a bit bored now, I want to do something with my ETH, and they're going to go buy NFTs. And there's also the people who make a lot of money from ETH and have just much more disposable kind of like income or disposable kind of like net worth, and they're like, well, what can I spend this on? And they go buy NFTs. So I think while ETH is pumping, it's going to be interesting to see the dynamics of the kind of like NFT ecosystem and if it actually outperforms ETH or which ones do. I think there are some projects that will, most of them maybe not. But then when ETH calms down and stops pumping, and kind of like go sideways for a little bit, I definitely think we're going to see NFTs like catch up. So it's just going to kind of like be this kind of like cycle going on, because the ETH rich definitely want to speculate on NFTs. Like all the big ETH whales that I know, they're all really into NFTs. They love buying NFTs. And it's not even just like the ETH rich. It's definitely people who are just like making a lot of money from crypto outside of NFTs, speculating on tokens and other coins and sort of stuff like that. They definitely want to use that money to buy rare NFTs and stuff like that. So definitely going to be interesting to see how that plays out. Second last thing here. So I've got Dan held blocked here and he's got me blocked, so I can't actually show you what he said, but he was spreading some absolute shit about, I guess like Ethereum again, like as he usually does, but I don't want to really focus on that. I want to focus on Danny Ryan's amazing tweet here where he basically says, it's very understandable that you don't know how this works. And I think he was replying to Dan saying that all the apps are going to have to migrate when ETH2 goes live, which is not true at all. And, regular listeners and watchers of the Refuel will know exactly what I mean by this. But, he says, it's very understandable that you don't, Danny says, sorry, I should say, it's very understandable that you don't know how this works. In the upgrade from proof of work to proof of stake, the core execution engine of Ethereum just keeps on chugging. This diagram might help clear things up. Now, I'm going to be honest, I don't think this diagram would clear anything up for Dan. He is like a Bitcoin maximalist. He has been spreading misinformation about Ethereum for a long time. But I want to describe this diagram because I know that this is probably something that you look at and you're like, okay, what's going on? This is super complicated. I have no idea. And you know what's funny? These arrows are actually backwards. So if you look at this picture, the arrows, you have to read, you're reading it from left to right, but the arrows are pointing to the previous block because that's how blockchains work, right? They basically, what's happening is that you can see the top, you have proof of work and the execution layer, which is the current ETH1 chain. Then you have the beacon chain, which is the proof of stake chain that we have, which is running parallel. So it's running as a separate chain to the proof of work chain that we're all kind of like using today. Then you have the first block of those two. Then you have the second block, and that block points to the first block because it kind of references that first block. And I mean, this is how the blockchains work, right? It's basically a linked list of kind of like blocks that go through and kind of reference each other. And then on the third block, what ends up happening is that this is the merge, right? In this third block where the execution layer is taken out and put into the beacon chain. So essentially proof of work goes away. The beacon chain or proof of stake is what starts validating the chain, and we get rid of the proof of work chain altogether, and it just becomes one holistic Ethereum. So that's exactly what this diagram is showing. Down the bottom on the third block here, from left to right, this third box, that's the beacon chain. And then you have all the properties of the beacon chain, such as the slot, the parent root, the state root, the signature, RANDAO, graffiti, deposit root, and then all attestations, deposits, and exits. That's all the logic that makes kind of like the beacon chain tick and proof of stake tick. Then the beacon chain is validating the execution layer, which has things like the parent hash, the state root, the base fee, all those sorts of things that make Ethereum, as we know and love today, and we use today, chug along, and all the transactions and stuff like that. So this is basically just showing the merge as it looks from like a technical point of view. Now, I think Danny was being a little bit funny here by linking this to Dan. Like, there's absolutely no way in hell Dan would have any idea what this means, because he didn't even know that, when we're going from ETH1 to ETH2, it doesn't require apps to migrate, because as you can see here, the apps are actually migrated into proof of stake automatically because of the merge, where the execution layer, which is where all the apps live, is just put in, is just kind of like ripped away from proof of work, and proof of stake replaces that on the next block. It's literally a one block difference. Like, you have proof of work up to block 10 million, just say as an example. And then on block 10,000,001, you have proof of stake and the same Ethereum that we know and love today, known as the execution layer, and everything's all well and dandy from there. So yeah, just wanted to explain that for people who may have been confused by that. And it's fine to be confused by that. I know I'm kind of making fun of Dan for being confused, but I mean, he's the one throwing out the misinformation and talking about crap right now. You guys aren't. So I think this is definitely not something that you have to worry about generally, like the ins and outs of this sort of stuff. This is definitely protocol level technical stuff, but it's still good to have the context around it and see what this means. So I just figured it was worth explaining there. This is a very long refuel, so I'm just going to finish up with this kind of tweet that Ryan Watkins from Masari put out today, where he says, as the smart contract wars heat up, it's important to keep in mind power and wealth distribution on each blockchain. Initial token distribution may not be everything, but eventually we may find these earliest decisions had lasting effects on the credible neutrality of these systems. Now, I've talked about credible neutrality on the refuel before. I've written about it in my newsletter plenty of times, but essentially you can see on this chart here the different kind of like token distributions of public blockchains. In blue is public sale, so what was available for the public. In green here, you have community allocations. So this is like this is like liquidity mining or airdrops and all the stuff that will eventually go to the community. Then you have insiders, which are team, company, and VCs. And then you have the foundations and others, right? The foundations are usually kind of like part of the team allocation, or the community governed kind of like grant pools, all that sort of stuff, or incentivization, whatever. You can see here that Ethereum is kind of like the best distributed by far, I think. It's funny because Cardano on the right here has like a massive public sale portion. But if you actually go back and see what Cardano's public sale was, it was actually a very closed off sale from memory. I think it was primarily marketed in Japan. It was kind of like this weird thing that happened, and from memory, it was just very closed off. Whereas Ethereum's was a global sale in 2014. Like, everyone could participate. There was no KYC or anything like that. But other than that, you can see in I guess like the kind of like orange here or red or whatever it is the most important, the insiders portion of it. Like, look at how bad some chains are when it comes to insiders. Like, I'm not going to make fun of any of them, but like some of them have like incredible VC and team allocations, which does in fact hurt the credible neutrality of these systems, especially if they're proof of stake. Because what ends up happening is that you have like these bunch of like proof of stake validators that are just VCs, and they are legal entities and known entities. If nation states and governments come towards them and basically kind of like say, hey, you need to like censor this transaction, or you need to do something on this chain, or else we're going to throw you in jail, I mean, they're going to do it, right? And it's not just that as well. The other part of it with the credible neutrality, these kind of like VCs could actually just put their weight behind, or at least kind of like the VCs and the team and the people running the validators and kind of like running the ecosystem can put their weight behind certain projects and bias towards certain projects. So their credible neutrality just gets eroded from that as well. But yeah, just thought I'd point that out. It's a much deeper discussion that I have time for in today's refuel. But anyway, I think I'm going to end it there. So thank you everyone again for listening and watching. Be sure to subscribe to the channel if you haven't yet. Give that video a thumbs up, subscribe to the newsletter, join the Discord channel, and I'll catch you all tomorrow. Thanks everyone.